Welcome to the discussion of Chapter 17 in your AIS textbook, Auditing and Evaluating the AIS, our final chapter. Our objectives for Chapter 17 describe the various kinds of audits you might encounter in your accounting or other career, explain the AICPA's 10 generally accepted auditing standards, GAS for short, discuss the basic steps, general steps associated with the financial statement audit, and then explain the connection between audit and AIS. So, textbook definition of an audit is a methodical examination or review of a condition or situation. Now, you're all going to be taking, of course, a full course in audit if you have not already. So we're just going to kind of scratch the surface of different types of audits, some of the considerations of a financial audit, which you'll focus on in that course, and then some other pieces that go along with that. So the types of audits we need to consider for discussional purposes. First is the financial audit, the one we're most familiar with. That's the independent exam of a company's AIS and financial statements and financial records. Financial audit is the unique province of CPAs. It's always conducted by independent CPA firm. And as you recall from your earlier courses in Principles of Accounting, all public companies are required to have their financial statements audited by a third party. So a financial audit will end in an audit opinion. Those four possible opinions are unqualified, qualified, adverse, and disclaimer. Unqualified, of course, is the one that every company is shooting for. An unqualified opinion means that the auditors have determined that the company's financial statements are, in fact, a faithful representation of the business and have been prepared in accordance with GAAP principles. Qualified opinion says, well, there's one or maybe a couple of items that don't necessarily conform to GAAP, at least as the auditors have interpreted it, but there aren't so many items as to kind of compromise the overall integrity of the financial statements. Adverse means that the financial statements were not prepared in accordance with GAAP. There are, material misstatements. There are representations that are not faithful, and there are accounting practices that have not followed those GAAP principles. And then disclaimer says, well, the auditors couldn't even really tell. So disclaimer, very, very rare. Generally, you'd only see those in instances where a company does not have adequate record keeping, adequate financial statement preparation. And again, that's going to be very, very rare. The second type of audit we'd like to consider is an operational audit. In an operational audit, the auditors are looking at a company's rules or procedures for doing business. So what they're trying to determine is if, in fact, the company's business practices make sense, and then if the company is following their own business practices. So in an operational audit, auditors will be looking at certainly any type of system or process documentation that the company has. So good examples here are all the documentation techniques we looked at this semester, like our DFDs, our flowcharts, and our REA models. Those are going to be kind of the very beginnings of determining whether a company is in fact following its own business processes, and then whether those processes make sense. So there's certainly some subjectivity there. And again, the auditors are going to issue some kind of opinion as to whether that's being followed or not. Generally, operational audits are only conducted by internal audit functions because, again, we're looking at a company's own business processes that have been constructed, not in the context of any kind of regulated environment, but more of those internal workings. Systems audit is used to determine if the technology employed in the system is actually producing the results it is expected to be producing. Systems audits require strong backgrounds in both accounting and then information systems, the technology side. Again, in a systems audit, we're generally talking about more of an internal audit function or the audit of maybe third-party providers of services, like we looked at with our ASPs in a previous chapter. Again, the purpose of the systems audit, just to determine if that technology is sound and is operating as it should be. A compliance audit is reserved for government and not-for-profit entities. It's often referred to, as a yellow book audit. because the Yellow Book, which is published by the Government Accountability Office, contains really all the government rules and regulations that those organizations are subject to. So really in a compliance audit, the audit team is looking at whether that government or not-for-profit entity is in fact following the rules prescribed in that Yellow Book. Compliance audits do require a solid understanding of governmental accounting, which, as you may or may not know yet at this point in your career, is very different from kind of our traditional business accounting. A management audit really examines whether a company is being run properly, and I'll put properly in kind of air quotes. So we're looking at the degree to which assumptions made as part of business decisions are assumed to be valid. Management audits are particularly relevant in times of economic uncertainty, as internal and external decision makers and stakeholders are looking at, whether their company is operating as it should be. Management audits, as you might imagine, have the highest degree of subjectivity. So really, again, it's one of those things where, does the audit team really know whether decisions being made by executives and managers and so on are kind of the best decisions that it could be made, or whether they're not. We also have investigative audits known as fraud audits. Those would typically be carried out by certified fraud examiners and or some other kind of constructed audit team. So really investigative audits are looking to determine whether business has been conducted in an ethical manner, whether there's some business practices that have not been on the up and up. Investigative audits do not determine guilt or innocence in any situation. Really, they're just looking to gather evidence to kind of confirm or disconfirm the occurrence of some kind of financial fraud or abuse. And then our last type of audit, international audit, we kind of call that the bucket audit, focuses on the foreign operations of U.S.-based firms or the operations of non-U.S.-based firms within the U.S. There's a lot of external factors involved in international audit. Really need to look at all of those factors in terms of language differences, culture differences, and even legal differences between U.S. regulations and foreign regulations. So an international audit requires a whole lot different context than our financial statement audits or our systems audits. The Auditing Standards Board of the AICPA developed the 10 generally accepted auditing standards. These are the guiding principles for conducting an audit. They're not all-inclusive, but they are there to serve as kind of that initial guiding focus for any audit engagement. The 10 GAS have been separated into 3 groups: general, fieldwork, and reporting. We'll take a look at what's in each one. So the general principles include training, which says auditors have to be trained in audit principles. Seems fairly simplistic, but it's kind of that first step to ensuring that audits are conducted in a professional manner. The general GAS also includes prescriptions for independence and professional care. Independence says the auditor must remain independent of the client or subject of the audit. So, the head of the audit team can't be married to the manager of the organization being audited. There's a conflict of interest there. Professional care says, has this thing been properly planned? Has this audit been handled in a manner that's appropriate to, the size, the scope, the complexity, and the importance of that audit engagement? Has the audit team executed, due diligence in planning that audit engagement? The fieldwork standards include prescriptions for supervision, internal control, and evidence. Supervision, fairly intuitive, just says, have the auditors on the engagement been adequately supervised? Is there a managing partner or audit manager who's overseeing all the activities of the individual audit team members? Internal control, again, just evaluating the risks and controls. SOX certainly pumped up the emphasis on internal control from a fieldwork standpoint. Evidence speaks to, just as it sounds, the evidence behind the audit opinion findings. So in other words, the audit team, when they're issuing this opinion of unqualified, qualified, and so on, is there objective as in not ambiguous, reasonable basis for that audit opinion. Is there evidence to support whatever conclusion is being presented by the audit team? The reporting standards speak to, first and foremost, GAAP. So are the financial statements being audited, are they in compliance with generally accepted accounting principles? Consistency. So the audit report certainly needs to address any inconsistencies from an accounting standpoint, period to period. So if there's been a big change in accounting practice from one period to the next, but the audit team has still determined that financial statements are in compliance with GAAP and are a faithful representation, then what documentation have they provided to explain those inconsistencies? Disclosure. So the users of any financial statement that's been audited can assume that the disclosures and the notes to the financial statements are appropriate unless the audit opinion states otherwise. So if for some reason those disclosures are not appropriate or not sufficient, the audit opinion should address that, even if it's an unqualified opinion. So even if the financial statements are found to be faithful representations and in compliance with GAAP, any lack of completeness in terms of disclosure should be addressed in that audit opinion as well. And then the last standard, their opinion, of course. We talked about the different opinions that could be issued for a financial statement audit. Again, those are unqualified, which is really the quote-unquote best one, the one that everyone's shooting for. Qualified, which again said that there's one or maybe a few items that aren't GAAP compliant, but it's not in such a bad state that the financial statements can't be used. Disclaimer and adverse, which are again the rarest and are the kind of bad end. So companies certainly wouldn't want to end up with a disclaimer or adverse audit opinion against it. So some very generic audit steps to consider. First and foremost, an audit should assess management's integrity. So does management set a good example by demonstrating ethical behavior? And as you can imagine, there's some subjectivity here, but the audit team should be looking at kind of the overall actions of top and mid and even lower level management in terms of creating that environment of ethical behavior. The team should also evaluate management's credentials. So is management technically competent? Are they financially competent? Do they kind of know what they're doing? Do they present themselves in a manner that would lead a reasonable, objective person to think that, they really are the ones pulling the strings here? The audit should also review and evaluate the internal control system, should certainly assess risk exposures from a control standpoint and determine if, appropriate internal controls are in place to mitigate those risks. So again, SOX, Sarbanes-Oxley Act of 2002, placed a much bigger emphasis on internal controls than was previously present in that environment. As you recall, as a result of SOX, management has to attest not only to the financial statements every period, but also to the internal controls over those financial reporting mechanisms. The audit should also perform compliance testing. So the audit should verify accounts payable and accounts receivable balances, should sample transactions, should count inventory, should check on assets to make sure those are being represented properly, make sure records are kept for the ownership of those assets, all those types of considerations. And then last, of course, the audit team should issue the audit report. Again, making that overall assessment as to the faithfulness of the representation and the compliance with GAAP of those financial statements. One more thing to take into account in terms of financial statement assertions. So really we can group those assertions into 5 categories. The first being existence or occurrence. So existence or occurrence speaks to whether the transactions actually occurred. Do the assets, liabilities, and all those pieces that are recorded in those transactions, do they actually exist? Is there some record of them, ever occurring? Are they under ownership of the company, and so on? Rights and obligations kind of goes along with that first one. So does the company own its assets? So the buildings that the company operates in, is there documentation that shows that the company is in fact the owner on record? Or is there a lease agreement that shows that they still owe a certain payment on that every month? Are the rights to those assets or liabilities properly identified? Again, is there proper record keeping to show, who owns those assets and what the company owes, if anything, on those assets? Valuation and allocation. So here we're looking at whether the matching principle has been followed and our accounts valued properly. So are we properly valuing our accounts receivable in terms of allowing for our uncollectible accounts? Are we properly valuing our asset accounts? Are we properly depreciating them or amortizing our intangible assets? Again, are we following the matching principles in terms of matching our revenues and expenses to the periods in which they're incurred or earned? Our fourth category, completeness. So is everything being reported in the correct period? Are we taking into account proper timing differences in terms of payments, accruals, deferrals, and so on? And is everything there? Is there evidence of transactions that have not been recorded? Why not? We need to look at certainly things like contingent liabilities. Has the company followed proper GAAP procedures in recording those potential future liabilities? And then the last category falls into presentation and disclosure. So again, are those financial statement disclosures, are those notes, are they understandable? Did the transactions hit the right accounts that were mentioned in those disclosures? Has everything been kind of bucketed correctly and presented correctly? That's really it for Chapter 17. Again, we really just hit the highlights of kind of introductory audit material. If you haven't had your audit course yet, you certainly will next year. So take a look at the practice questions from the end of your Chapter 17 and also the practice test questions that go along with that material.